Good morning. I think it's good morning for all of us, a very early morning or late morning. So good morning, everyone. Welcome to this regional training on methodologies for measuring illicit tax and commercial illicit financial flows in Africa. I hope that most of the countries were able to register. In case you have not registered, please write to Ekaterina. Yes, Bojan will be putting the information in the chat.
We can
box.
hear her.
Hello. Okay, just a second.
Yes, we can hear you.
We can hear you, Susan. Please go ahead.
So I was saying that in case you were not able to register for the training because it's running on until the 13th, kindly write to Ekaterina, send her your full names, the name of your organization or government institution, and also your phone number and title. She'll be able to help you with that. So thank you very much, colleagues. We don't have all the opening and welcome remarks as we often do. We will go straight into the training. Let me just try to remove my video to save some bandwidth. I will be moderating today's session and just a second. So we'll go straight into session one. Session one will be presented by Bojan. This is focusing on profit shifting, method 3, global distribution of MNEs profits and corporate taxes. Bojan, over to you. Thank you.
Thank you, Susan. Good morning, everyone. It is a pleasure to be here. Just before I continue and move on, maybe just a few additional housekeeping rules. First one is the general, so please keep yourself muted unless you would like to raise a question. Please, you can use your chat to do that, or you can also, raise your hand and we can do it in between our presentations, so on. So today's session is not meant to be as a presentation and then a Q&A session in the end, although we can also do it like this. We can rather work and go step by step, and as long or whenever there are any questions in between, please feel free to jump in to pose a question and we will try to address it. In the first session, I will try and give a brief overview of today's method as it is described in the methodological guidelines to measure tax and commercial illicit financial flows. And in sessions 2 and 3, somehow combined, we will have a few researchers, prominent researchers who have done the actual application of the method. So we should have some first-hand experience throughout the day. Just maybe a quick side note, in the chat we have posted the link to the website where you can also find the presentations of today's, so the PDFs of today's presentations, which may help you guide along. As for the language you're observing, so most of it will be conducted in English. However, there are simultaneous interpretation into Portuguese and French available today. Thank you to the interpreters also in advance for bearing with us. I know this is a very technical and challenging topic, but I fully believe we will be able to deliver the training in properly. The materials, so the presentations or any other materials are currently available in English, but they are being translated as we speak. So as soon as they are available, we will be posting them online as well. Please know that towards the end of today's session, we will try and share a link with you. We will be very happy to receive your feedback on today's session on the training delivered. So please take a few minutes to respond to those. Okay, so with this, I am now gonna, to say some bad, I'm gonna turn off my camera, but you will still hear my voice, and I will be sharing my screen for the presentation. if you can just confirm that you can see my screen and you can hear me. I guess, yes. I have another computer actually, so I can see that. So thank you. Okay, so in today's session, we will be addressing one part of tax and commercial illicit financial flows. So this is the so-called profit shifting or aggressive tax avoidance. We will be looking into the method on the global distribution of multinational enterprises' profits and corporate taxes. Now, before we start with this method, just a very brief introduction or overview. When we decide to look into the profit shifting, so how those flows of profit shifting are taking place, of course, one obvious starting point would be to look at the aggregated statistics, such as the balance of payments or the foreign direct investments, even foreign affiliates trade statistics. In the guidelines, which I believe you have already seen or at least heard of, they're available online in the draft version. So the profit shifting, so there's a case study indicating there, a nice case by the IMF, showing that profit shifting may not distort the aggregate account balances in the balance of payments. However, it will affect their components. So, we have the trade account or the income account. So there are some signs observed directly in there. And then, of course, we could also have analysis of aggregated data that would provide some valuable insight into profit shifting using FDI statistics, or maybe even better, share of FDI or ratio of FDI to GDP. So those can really provide strong inclinations that something is happening in the field of profit shifting, or they can try to help us understand which economies are more prone to being, inducive for profit shifting or not. However, all these macro approaches may not fully capture the aspects of illicit financial flows, or maybe separate them sufficiently from other flows that will provide us to provide an accurate measurement. We are striving here today or throughout this week to address the statistical measurement of illicit financial flows, which means that we are primarily observing what the national statistical systems, so national statistical offices, but also other that are engaged in the statistical work in the country, how they could build on their capacity, build on their data, share those experience, data, and expertise to produce a nationally compiled early statistics of illicit financial flows. In recent years, specifically years, but also, let's say, we could say this stretches beyond, let's say, for another decade or so, there was a strong development in methodologies to measure the multinationals' profit shifting. And even though they are slightly different in terms of model specifications or approaches, there is one concept that is firmly rooted in all this existing economic theory. And that is that the declared profits are composed of two parts. The first one is the real profits or the unobserved profits, and the other one is the shifted profits. So we are trying to address this using various methodologies and various approaches. Three of them have evolved in research literature. The first one is the so-called profit misalignment. So those methods compare. Can I kindly ask participants to mute themselves? Wait, I have to. Okay, apologies for that. So where were we? Yeah, so the profit misalignment method is actually comparing what a certain multinational enterprise or its unit reports as profits and compares this to their economic activity in the same country. And any misalignment between the global shares of this unit's profits and economic activities would be judged as a sign of profit shifting. So for a clear example, if unit A in country 1 has 50% of its capital and labor inputs, but it only reports 5% of their profit, this is a sign that something may be actually happening. I'm sorry, I'm hearing some echo right now. Okay. The second approach, or that has developed over time, is the so-called tax semi-elasticity method. That is essentially starting from a regression on the reported profits on the left-hand side and the tax rate on the right-hand side, which is then, of course, controlling for proxies of, capital and labor inputs, but also other indications of what is going on in a specific country or at a specific firm. With this regression that is being then estimated, the scale of profit shifting is derived by, looking at what if the tax incentives, so the tax differences would not exist, what the reported profits would then be. And the third one is the method that compares multinational enterprises with non-multinational enterprises, so with domestic firms. And it is essentially building on the idea that if there were no profit shifting, the profitability of MNEs should be similar or equal to those of domestic firms. And any systematic deviations or differences between those two is clearly marked as a profit shifting sign. All these approaches, of course, have pluses. All these approaches, of course, have minuses. In the guidelines, 2 of the methods have been selected. So this is method number 3, which is the global distribution of multinationals' profits and corporate taxes. So this is the tax semi-elasticity method, which we will be looking into today. And there is another one, which is comparing multinationals to non-multinationals, so to domestic units, which is the one we will be looking at tomorrow. So for today, we say we're going to look at the global distribution of multinationals' profits and corporate taxes. And if we take a look, we see that, of course, so this is the tax semi-elasticity approach. So it is building on the second method or the approach that we have mentioned earlier. It is essentially looking at the distribution of profits of a multinational among its units globally, and how this relates to the corresponding corporate effective tax rates and some underlying economic activity of units. I apologize, I keep hearing echoes, and can I kindly ask participants to mute themselves? I'm trying to do it. I apologize if I have unwantedly muted any of the interpreters. Please kindly help me out. Thank you. So the method is essentially building on the major assumption, which is that MNE unit is likely to shift profits out of the country if another unit's tax regime induces a lower tax rate. So within an MNE, so multinational enterprise group, our units are going to shift profits from one unit to another in order to minimize the taxes that they have to pay. So profits are going to be shifted to lower tax units. And any systematic deviation from those predicted profitability would be treated as a sign of profit shifting. Now, we've put here in red that there should be caution in interpretation of the results. It is essentially very important that whatever results we do obtain using this method, we interpret them with extreme caution and preferably analyze together with estimates compiled using other methods or with the expertise that is available at a national level on various multinational enterprises and so on. So this is a method that may produce sometimes unreliable results, and therefore we need to be very paying much attention to addressing the results of this method. Of course, we mentioned earlier, so every of the methods that we are proposing has limitations. When we are addressing illicit financial flows, the problem that we are facing, of course, in the statistical measurement part, is that illicit financial flows are hidden by definition, which means we are not observing those flows directly. We have no means of doing that. Rather, we are observing the traces that they leave in official statistics or in official economies. So we always are, approaching them. We're making estimations and making assumptions in order to come up with some sort of values. However, this brings along certain limitations. So the first one is already, as we mentioned earlier, the uncertainty about results. There is an overall uncertainty whether this method would provide underestimates or overestimates of the profit shifting. And of course, this could vary by country. So this would depend on various national circumstances. And therefore, it is important that we take those considerations in our mind when we are applying this method. Determining the tax rate that a specific multinational unit is facing in a particular country may not be so straightforward. So of course the question comes, so what are the tax rates that are being faced by specific units? We know that there are certain incomes facing different tax rates. We have so-called patent box regimes, offering lower taxes or lower tax rates on certain incomes. We have specific tax reducing arrangements with the government, allowing a multinational to come into the country and pay reduced tax rates for the first 3, 5, 10 years, or we have incentives to pay less taxes for research and development activities and so on. So all these have to be brought into the picture when we are discussing what is the tax rate that a specific unit is facing. There may also be other non-tax incentives to shift profits. Examples would be, fear of expropriation or something. And moreover, the tax differential between domestic multinational unit and the one MNE unit that is abroad may not fully capture incentives to shift profits. So there may be other incentives. As in all economic theory and then econometric models being based on it, of course, the underlying assumption is, you may remember, the rationality of behavior, which may not always be the case, but sometimes it can cause some of the problems. And finally, we can say that the tax sensitivities of profits may vary, first of all, across different tax regimes, for example, between high and low tax jurisdictions, but also depending on the size of the multinational enterprises. It has been shown actually that the larger multinational enterprises account for a larger share of profit shifting. Of course, there are ways and proposals how to overcome those limitations. And some of those limitations can be mitigated with the list of actions, and we're going to go through all of them step by step. So the first one is to use effective tax rates, so effective average tax rates, rather than statutory tax rates. Why? Well, the effective tax rates would provide a more comprehensive representation of a country's corporate income taxation. So it would be effectively what the companies will have to pay in terms of taxes, so they would be better suited for this analysis than the statutory tax rates. The statutory tax rate, of course, why would one use statutory tax rate? A very practical reason is that those data, so statutory tax rates by countries, are available. So, we can use them, we can find them easily. However, it has shown that, they may not fully reflect the tax or the income taxation in the country. I think there was one very clear example showing that, for instance, both Luxembourg and Malta have high statutory tax rates, I think even about 25%, but we know in practice they are somehow being treated as a tax havens. So statutory tax rate may not provide a best picture in terms of taxation. When we use microdata, of course, this would provide us a potential solution to calculate the effective tax rate, because we can use those microdata to calculate effective tax rates. So whenever we can, use effective tax rate rather than the statutory tax rate. The second way to mitigate some of the limitations of the method is to use a non-linear specification of the model. So here we propose to use a quadratic tax variable specification. In order to account for uneven tax sensitivity across various tax jurisdictions, non-linear specifications of tax variables have been applied. So there was quadratic, there was cubic. In some cases, there was also logarithmic model, and I think this was also going to be the case that will be presented later on in the case study session. So what we propose to do is to use the quadratic tax, which means that we have a tax variable plus a squared tax variable in the model, which we will take a look into later. However, there should be, of course, a clear notion here that in cases when such a specification would not turn out to be appropriate, or maybe not sufficient enough to account for our data, of course, we should be applying or searching for a more suited alternatives depending on our national circumstances. To address the question that different size MNEs would, of course, have different levels of profit shifting, we propose to use a subsample, specifically quartiles of consolidated revenues. So the research has shown that the tax sensitivity would depend on the size of the MNEs. So different MNEs would shift different amounts of profits. There were two main let's say, streams in the research. So one was to use the estimate the model on the subsamples, and the other one would be applying the weighted regression. We have a case study that is using the quartiles of consolidated revenues, and if data allows for that, so if there is sufficient enough data to have 4 different regressions based on all those 4 different sizes, we propose to go with this. Last but certainly not least is the proposal to use various tools to confirm and interpret results. So this last point is not a econometric part. It refers more to the involvement of experts of profit shifting or of multinationals in a country. Specifically, we propose that there are 2 tools to be used to confirm or interpret the results. The first one is the so-called location of the unit. So this would relate to the tax system in a country or to the labor costs and so on, to essentially identify the role of the unit in the tax strategy of the multinational enterprise. The second important element to be looking at is the economic activity of the unit. So which would be assessing, to a certain degree, of course, the technological nature and role of each unit within an MNE's production chain. So both of those elements are important to be brought into interpretation phase. For example, if one of the units using the model is seeing that it is being shifting profits out of the country, but it is a unit that is within an MNE, the one that is least taxed and exhibits all the signs that something is actually not supporting that this unit would be shifting profits out of the country, then we should revisit the specifications so the input data or any other potential reasons why this may be actually happening. Now, those tools, so location of the unit, so those tools that are so the location of the unit and the economic activity, they can be based on either aggregated data, or they could be based on firm level or microdata. Now, comparing the results from this regression analysis also to, let's say, a comparable unit or an MNE on a case-by-case basis can help, of course, also to validate the results. Of course, those processes would be very resource intensive. Therefore, it is important whenever there are options, whenever there are large case units, so large LCUs in place in the statistical office, those would be perfectly placed to address the issues of multinational enterprises profit shifting. In the absence of LCUs, of course, other experts should be brought to the table to this research to validate the results, therefore to increase their reliability of the method's application. Now, what type of data do we actually need in order to apply this method? So this method would require data on MNEs, so on multinational enterprises and their units. So we are ideally looking at the unit level. So this is a affiliate, right? So every specific unit in our country, but also in other countries. So we are looking at profits, effective tax rates, number of employees, tangible assets, and so on. As mentioned, ideally, we are looking at microdata, so it's firm level data, and we do have access to all of that. Now, in an ideal scenario, of course, we would have data, not only the units in our country, but also all other units in all other countries, or the entire web of multinational enterprises, which is usually not really the case. Statistical authorities would mostly have data on domestic multinational enterprises with information on their units in other countries, and they would have data on foreign-owned multinational units in the domestic economy, but not their units abroad. So where to get those data? So one of the very prominent data sources, which is also going to be showcased a little bit later, is the so-called country-by-country reporting by OECD. So all the MNE groups that have more than 750 million euros of consolidated group revenues are required to report that. So this is a very good data source. However, it may not turn out to be practically possible, of course, in all the countries where those units are not there. There are thresholds. I just mentioned the 750 million consolidated group revenue. So some MNEs may be smaller than that. In those cases, national statistical authorities can access detailed data on, I'm sorry. So national statistical authorities can also access detailed data on MNE units that are active in the country. For example, analyzing firm level tax returns from national tax authorities, from business statistics or tax data, and so on. So those could be analyzed either independently or in conjunction with the country-by-country reporting. This would very much depend on the national settings. Of course, the big question mark here is data availability. There are other sources of data that could be used to supplement the nationally acquired data. So we have the OECD ADIMA, which is the analytical databases on multinational enterprises, or we have the MNE from OECD, which is the activity of multinational enterprises. We have OECD's tax database, but then we also have others. So we have the Global Groups Register, we have the Eurogroups Register. There might be other registers that are trying to compile data on multinational enterprises that are active in a specific country or region. So those global data sources can be used when appropriate as complementing or supplementing data that we have at the national level. Now, the method would also require data on various conditions in a country, such as the population size, the GDP, the tax rates, and so on. All of those will have to be sourced from various international databases, such as the UN data or the UNCTAD statistical database. And different researchers, different applications have, of course, used different data sources. This would also then depend on specific country or statistical system, what data sources they would already be having. So once we have the data assembled, so to say, we have them collected and ready, we can move on to the next phase, which is the calculation phase. Now, the method is estimating profit shifting in 2 steps. The first one is to determine the presence of profit shifting by using a semi-elasticity of profits and taxes. And then in the second step, measure the size of profit shifting flows. You may remember that essentially our whole exercise of the measurement is to, of course, provide evidence for policy making, but also to report on SDG indicator 1641. So we need to come up with the second step, which is the size of the profit shifting. We need to know how much profits have been shifted out or into the country. So both flows are important, inward and outward flows. So the first phase in determining the presence of profit shifting is essentially described by this empirical model, which we can see on the left-hand side. We have the profits before taxes. Specifically, we propose to use, and which has also been done in the research, to use the logarithm of the sum of profits before taxes of a particular MNE unit in country C in time t. So this would all depend, so those subscripts would be depending on what data are actually available. Of course, this brings up, several questions. For example, one question is, so what happens? So those profits have to be positive. If I have a value of 0 of negative profits, then this equation simply truncates those. So those are some of the questions we may be looking into or asking later on in the presentations, in the case studies and the examples. But of course, this is the model that is specified. Then the other part, so the right-hand side, we can see that we have the tax variables. So we have the quadratic specification. So we have t and t square. And then we have other vectors. So we have a firm level and a country level specifications or characteristics. And then we, depending on data availability, we would be also accounting for multinational units fixed effects or the year fixed effects and so on. The main interest in our calculation is the so-called tax variable. So this is the variable t. So this tax variable in the model is defined as a difference between 2 parts. First, the tax rate that is faced by MNEs units or by MNEs unit I in country C. So what a particular unit is facing, what tax rate it is facing. And the second part would be the unweighted average of tax rates that are applied to the units of the same multinational enterprise in all countries apart from our country. So in other countries. So this is important to see essentially. So the main idea here is that we are comparing what our unit has to pay taxes compared to what other units in other countries will have to pay. And of course, the idea is if those other units in other countries have to pay less taxes, we are going to shift our profits abroad and vice versa. So this tax differential, so this tax variable is essentially crucial. And this is what we're trying to do in this, we're trying to estimate in this model. As mentioned earlier, we propose to use the effective average tax rate rather than the statutory tax rate. Now, in some cases, this is not possible. However, if we are using microdata, if we have microdata that are available, we, of course, have to make full use of that to calculate the effective tax rates. In some cases, the effective tax rates by countries can be accessed through some international sources like the OECD's tax database, although not for all the countries. Now, in cases when this would not be happening, we of course can make use of the microdata that are available. So the first one is we can calculate the effective average tax rate from microdata in country as a sum of taxes that the MNEs pay in a country divided by the reported or declared profits in this country. To avoid any problems with endogeneity, the proposal is that this effective tax rate is calculated using information on taxes paid and profits reported by other MNE units in country C. So not on our unit, the one that we are observing, but all the other units in that country C. Moreover, in different cases, depending on, as mentioned earlier, on data availability, if data availability is limited, of course, we can first use effective tax rate as reported. If those are not available, we can, assign a value of 0 if statutory tax rate is 0. And in all other cases, we can calculate it as a difference between statutory tax rate in the country and the median difference between statutory and effective tax rates observed in the populated data set. So this may sound maybe a bit tricky or hard to imagine, but this would actually depend on what data would be available. So at the country level, or maybe at the units level. So in practical applications, this will depend and this will vary. So I propose that we actually take a look at this later on in the case studies. If we move along, so we have the firm vector, which would be including variables that are depicting units' economic activity. So we have the labor and the capital inputs, so the number of employees or the values of tangible assets. And similarly, the country vector would include specifications or characteristic of a country where particular MNE units would be placed. So we're looking at the GDP per capita in purchasing power parity and a population size. There may be other variables to be added. I think as a general rule, but of course econometricians would be better placed to really advise on this. We should be wary of over determining the models or over specifications. We are still using the models, we're still using econometric models, so we can not account for every single specificity in a country, but if there are really specific elements, we should be taking those into account. In our quadratic specification of the model, the coefficients marked here, so beta 1 and beta 2, are, they are composing the so-called semi-elasticity of profits with respect to the tax rate. In their interpretation, we have to compute a marginal, so a combined marginal effect of tax rate, but at a certain tax level. If we would have a linear specification, so only t, not t square, then of course it wouldn't really matter at which tax rate we would be calculating the marginal effect. In this case, we need to calculate it at a specific tax rate, for example, at 10% or at 15% or 20, and the result would say, let's say a combined marginal effect is minus 0.01, would mean that a 1 percentage point higher tax rate would be associated with a 1% lower declared profits. So in our anticipated result of the marginal effect would be that it is negative. And of course, the whole method is building on this premise, on this assumption. If, however, we cannot prove this econometrically, we have to revise the data inputs, the specification of the model, or any other required specifications to that end. So the estimated parameters of semi-elasticities of profits with respect to the tax rates are the results of this first step, so beta 1 and beta 2. And these are used directly in the second step to observe the, or to measure the profit shifting flows. So we are looking at the size of the profit shifting. So in order to provide a dollar measure of IFFs, because this is what we want to do in the end, we actually observed how the declared or the actual profits would change if different tax rates were applied. So when the tax incentives to shift the profits would be removed. So we are essentially looking, if there was no profit shifting, how much profits would you actually declare? So in order to get there, so to calculate this profit shifting, we first recognize that the actual or the declared profits are the sum of real profits and shifted profits. And moreover, we understand that the shifted profits are essentially therefore a part of real profits, and they're linked or combined together with the tax elasticity through a tax variable. So doing some algebra, we essentially come up with a formula to estimate the shifted profits as using this formula. So we are inputting the declared profits, which we have, and the tax variable, which we also have then estimated using on the model. Results are being calculated for each MNE and of course per country, that can be later on aggregated. What is important is to know that whenever we observe a negative value of S, this will be indicating that a profit is being shifted out of a country. So we are talking about the outward illicit financial flows. On the other hand, positive values of S, so S is more than 0, would indicate that profits are being shifted into a country. So inward illicit financial flows. So, and both are important for the indicator, but not only for the indicator, so the SDG indicator 1641, but also because both, so inward and outward illicit financial flows have detrimental effects on our economies and societies. So moving ahead, we see that the outward illicit financial flows can be calculated using as a sum, or whenever we said that the S is negative, and the inward illicit financial flows whenever S is positive. However, I think it is important to still keep in mind that there are certain limitations in the data coverage. Here we have the underestimation from data under coverage. If we were to apply the OECD country by country reporting data, then we have under coverage, because there is a specific threshold under which units, the MNE units, are simply not included in the data set. So we may have to provide either additional sources or knowledge, so any national specific circumstances to be brought into the play with experts and provide some sort of enhancement. So there could be a scaling up of the results, which has been done in the case of Germany, or there could be some other elements that could be brought into the picture in order to fully capture the outward and inward illicit financial flows due to profit shifting. This, of course, is not an easy task. And as we will see later on today in the case studies and the examples, a lot of efforts have been put into the calculation, into the understanding, and at a national level, all of those have to be taken into consideration when producing a final version of this early estimates of the illicit financial flows. Okay, with this, I think I will stop here. I think I'm still in time, but Susan, so please, I'm back to you.
Thank you. Thank you, Bojan. Thank you very much for the presentation. I see there was a question from Shebo. I don't know if you would like to take it. I know you mentioned about Q&A not being there, but you can advise, because we have about 4 minutes left.
Okay, so let's, I think we have, yeah, we still have about 4 minutes, but then we also have a longer break. So we can, I think we can try and take a look. Let me just try and read the questions.
Can I read it?
From Shebo, right?
Yes.
Indigeneity problem, you say we should compare with other MNEs. Should be a pre-matching. Okay, so we are not, so when we are comparing in terms of tax rates here, we are not comparing one unit to a different unit in terms of and ensuring that we are comparing like with like. What we are essentially only looking at in this method or in this step is to say, how much taxes do I have to pay? So my unit compared to other units. So therefore, we are just observing the tax rates that are being paid in different units. So regardless of their size or the activity or of their location, it just has to be a condition met that essentially we are all within the same multinational enterprise group, which means that ideally, you know, I could move my profits from my MNE unit to a different sister unit in a different country. I'm not sure if I fully was able to respond to that, but essentially we are only comparing the tax rates, and if there is a lower tax rate, this gives us incentives to move profits out of my unit to a different unit.
So Shebo, are you happy with the response? We have
I thought, yeah, I thought, thanks, Susan. I thought that at least you need to have an idea of the characteristics of what you're comparing with, other than just doing something blanket like that. I don't know.
Yeah, I mean, there is, of course, other factors are being taken into account. of course. I see that there's another question in the chat, which I think might relate to that. So how do you deal with sector-specific behaviors? Will that be captured by the firm variable or this vector? Or is there a need for a sector variable too? For example, it says firms in the mining sector might systematically be behaving differently from firms in light manufacturing. Of course, this is all true. So how much we can bring all of those questions on board would depend on, of course, data availability. If we have those data, of course, we can use it. Some of the research has essentially used the industry level fixed effects when they were doing it, so that essentially they were, comparing those things, so the tax differentials, but also everything that is already accounted for in the firm vector, such as the labor inputs and the capital inputs. So those are being taken into account, of course. And some of the research has also been doing to somehow compare and take into account the specific sectors or the economic activities at whatever ISIC level there was. So yes, all of these are brought into the picture in this in this regression model. So we are taking those into account, but this would depend, first of all, on the data availability, and second of all, this would then also depend. This would be then taken into account in those specific vectors or variables. In the tax variable, this difference, we are only observing the difference in the tax rates. Thank you. I see a question up,
Yes,
or hand up. Yeah, please go ahead.
There is another question in the chat.
There's another question in the chat. Okay.
Yes.
Can we also regress on debt to equity ratios and asset intensity, as there are known tax shields that will show effort to evade too? Shifting of debt and assets still can be indicative of IFFs as they have value. Well, I mean, I think those questions will be definitely better placed for researchers when we move to the other session. But generally speaking, other things can be, of course, and should be brought into the picture, but we have to be careful of what we are essentially taking into account, not to confound various elements, and to try and keep the model, I'm going to say, simple in terms of that we are addressing. So let's see how the profits are being shifted as a response to the tax rates. So, but then also account for other things. There was, I think, believe a case with Germany when they were looking not only at the profit shifting, but they were looking so not only at the declared profits, but also the intercompany. Now I forgot what it was. I think that the intercompany, so within the MNEs, shifting of or related trade. So this would be a sign of, trade mispricing potentially. But there are different implications of such models in terms of interpretation of the results. So I would say, yes, all of those could be brought into the picture, but I think we have to be very careful in terms of what we essentially want to do. But I will ask Anastasia, maybe we can readdress or reopen this question later on with Petr, Miroslav, or Bathusi in the later sessions.
Thank you, Bojan. Would you be able to take another question? I see a hand.
Yeah, I think that there's a hand, so I think maybe we could just give. Yeah, Said, yeah.
Sim, bom dia a todos e muito obrigado. Eu congratulo o Bojan pela brilhante apresentação sobre essa parte da metodologia. Eu tenho duas questões. A primeira, não sei se terei ficado ultrapassado em relação à transformação logarítmica que é apresentada nesse cálculo. Não sei estava aqui a pensar de que se o lucro é negativo ou é nulo, então não é possível haver essa transformação logarítmica, porque o logaritmo não existe logaritmo para números negativos. Não sei se terá dito alguma coisa sobre isso, talvez tenha ficado ultrapassado. A segunda questão tem a ver com a forma de cálculo do imposto, da variável de imposto. Então, tem duas componentes. A primeira componente é a taxa que o país enfrenta a multinacional, a empresa multinacional no país, mas a segunda componente, ele disse que era uma média ponderada das taxas, dos impostos de outras unidades multinacionais dos outros países. Eu queria saber qual é a base da ponderação para esse cálculo. Então, são essas duas questões que eu tenho. Obrigado.
Okay, thank you. I think I got the question. So the first one, yes, if the profits are negative or if the profits are zero, since we have on the left-hand side the logarithmic, then this would of course mean that they would not be able to be calculated or taken into account. So the main idea behind this is that we are shifting profits. So we are observing how the profits are being declared or shifted. Of course, losses may be a completely different story. They are very important, of course. We need to know what is actually going on in those cases. We know, for example, I think that was it last year or maybe 2 years ago, a Amazon unit in Europe made record-hitting sales during the COVID. However, I believe that the Amazon unit has in fact declared not major profits, but even more so problematic, they have declared losses. So not only did they pay zero taxes on their profits, even though they had record sales, but they have also received some government subsidies. So of course, this is a problem. Honestly, I think that this is a very practical and technical question. I would again like to push to the second session to be responded or addressed by the researchers who have a lot of experience in applying this method. So apologies for that, but thank you for your understanding. Now, on the second part of the question, which we can also address afterwards, and I'm pretty sure they will be sharing valuable information on how to address the tax rates or the tax variable, so as a tax rate differential. Yes, so in this model, so the proposal is that we are looking at tax incentives to shift profits, which means that we are always observing a specific unit of an MNE. So how much me as a unit have declared profits and how much taxes do I have to pay in terms of what is my tax rate? And I'm always comparing if I have to pay 50% tax, how much my other sister units, so within the same MNE, but in different countries, how much they have to pay. If they have to pay less than 15%, I have incentives as an MNE in total to shift profits from my unit, 15%, to a unit that has only 10% effective tax rate. So from the perspective of my unit, I'm just trying to see how much taxes am I facing as a tax rate and how much other units are facing. We know, so when we observe or when we study multinational enterprises or enterprise groups, we know that specific units have different roles. Some are production units, some are just transferring on conduit units, and some are headquarters and so on. So they're all based in different locations based on either there is a lower labor cost, there's some regulation requirements are a little bit less, taxes, and so on. So those would all be taken into account when the units are being profit shifted. But when we observe tax incentives to shift profits, we are in this tax variable concerned with how much taxes do I have to pay vis-a-vis my sister units within the same MNE. I don't know if this has responded to your second question, but I think we can also address it later on with a practical example. I think it's going to be much more clearer. But please let me know if there are any pertinent questions still open. Thanks.
Thank you. Thank you very much, Bojan. Good morning, everyone. Technical working groups, representatives of the regional RCO's regional coordination offices. You're welcome to this second session. I hope that we can start. It's exactly 10:30. We have on call Peter from the Charles University Prague. I'll let him introduce himself and then we can start. You're welcome, Peter. Good to have you. Thank you.
Thank you. Thank you for chairing this meeting, Susan. It's a great honor to be here, although virtually, with all of you. And I'm going to be presenting most of the time research, joint research with my colleague Javier Garcia Bernardo, who's based in Amsterdam. And the title of my presentation is Profit Shifting of Multinational Corporations Worldwide. But why we are here today, as Bojan very nicely outlined in his contribution, is because we want to estimate illicit financial flows, because they are important in themselves, but also because there is this sustainable development goal. And I've been working on illicit financial flows since my studies in Oxford. My first authored piece was that I contributed to Financial Secrecy Index, indicating tax havens, a project of Tax Justice Network, and I've been estimating the scale of profit shifting since 2012 with various data sets and with various methods. And now the paper that I'm going to be presenting today is a culmination of my efforts to estimate profit shifting of multinational corporations worldwide as best as we can. And we do so with the use of the tax elasticity method, which is the first method proposed in this program. But it's also wider body of work, including my research, but other researchers and research papers, and me and my colleague Alex Cobham, the CEO of Tax Justice Network, have written up a book that came out last year in the Oxford University Press, which is exactly about this topic, estimating illicit financial flows. And in fact, this book might be useful to all those interested in profit shifting, but also in the other dimensions of illicit financial flows. So we provide critical reviews of methodologies and data for profit shifting, but also for the other methods that some of you might be interested in using, including offshore wealth and using international trade data to understand illicit financial flows. So this book, partly based on previous policy papers for UNCTAD and other UN agencies, is freely available online, so it's open access. So you can use it as a reference. So this is a small commercial to begin with. What I don't probably need to stress too much is why we are here, and that's the illicit financial flows and the SDG target 16.4. But there are also other reasons why we might be interested in estimating the scale of profit shifting. The tax avoidance by multinational corporations create uneven level playing field with the other companies, including domestic ones, which do not make use of tax havens to avoid taxes. Of course, many of you will be working in various government agencies and will know that this tax avoidance can and does result in lower government revenues. And of course, the tax avoidance has also the unfortunate impact, on tax morale, that people are less happy with globalization are less likely to they're more likely to view globalization as
donc
inequitable.
nous devons regarder également l'aspect de
I think
mondialisation.
I think the interpreters are no longer assigned. There's an issue with the interpretation. It's been deactivated.
Oh.
Yes, I'm sorry. I'm trying to understand what is actually going on. Sorry,
Yeah,
Peter.
We have
just
a-
for
We have
interface has
a French
disappeared.
interpreter. But
the
the Portuguese-
interpreters. Yeah, the Portuguese interpreter apparently is no longer here. Or I mean,
Actually,
he's
we are
here.
We're just
Yeah.
not
I'm
assigned.
sorry. You're not assigned. I'm just trying
Not
to.
assigned.
But I have the same problem that we had earlier, so I could
Yes,
not.
we've just been deactivated. The interpretation has just been deactivated, but we were
Yeah.
a few
It was working.
moments ago.
Yeah. I have no idea what happened in the meantime,
I'll
honestly.
be checking with the Katarina.
It's not the Katerina, it's Jean-Philippe. So UNCTAD IT, is anybody here?
I asked them to join.
Okay, thank you. So just a question, is it only the Portuguese interpretation who has been turned off?
No, even
No,
French.
even the French.
Okay, so everything.
Yeah.
Okay. Look, I'm gonna have to wait for the IT to get back.
Let's give this about 2 minutes. Apologies, colleagues, about this.
All right.
Yeah.
Nos excuses, chers collègues. Nous allons patienter quelques minutes pour qu'on puisse résoudre le problème technique lié à l'interprétation.
Also, just to mention, Peter, taking into consideration that we have interpretation in Portuguese and French, hopefully to take it into account in the presentation.
Juste pour demander à l'intervenant de prendre en compte qu'il y a des services d'interprétation en français et en portugais.
Só para tomar nota que há interpretação que está disponível ambos em português e francês.
Okay, we can resume. I don't see the activation on my screen, but we can resume because they are now all online. Thank you. Sorry about that. We'll resume.
Sorry, we were online, but we just don't have the interface.
We've been online throughout. It's only that we don't have the interpretation interface, huh, Susan?
Susan, please, I think we have to wait. I don't know what is essentially going on, but yeah, so they cannot be assigned as interpreters. So we were gonna have to wait for the UNCTAD IT to get back. So
Okay.
Apologies to all the participants. Apologies, Peter. Maybe we can just wait another, I don't know, let's say just give it a 5 minutes break and then we will resume. Apologies.
Okay. Bojan, do you think it's the same case of leaving and then logging back in?
This might be the case, but honestly, I have no idea as we have so many things already in the recording.
Okay, so let's stop the recording.